where you have 1, that indicates a bullish type of situation or a shift in the situation to a more bullish type of situation. When you have 0, you have a bearish situation. This is important only really at the beginning of the move when you're trying to get on board. You want your indicators to line up. Very important, obviously, to get off to a good start, and that's what you're trying to swing here when you're in a swing trading type situation. You want to get off to a good start in that trade. A couple of things about these indicators in general. Of course, the angle is important. What is our angle? And if it's obviously up, you got the line moving up, uptrend. The same is true on the moving average as well as on the predicted differences that you see down below. The predicted differences down below is the difference between a predicted moving average and an actual moving average. The blue line is a medium-term moving average comparison. The green line is a long-term moving average comparison. So you're looking at that as a more of a momentum type of a indicator. When the market is swinging up, you look at that turn and you will see that frequently that predicted difference is starting to turn before the price or before the moving average starts to turn. For example, when you have the situation right here where you had the predicted difference, the blue line crossing over that green line, indicating a start of a downtrend, and you can see that is before this move here started to make its downturn, and even while it mishmashes around up here at the top, kind of an indication that maybe the situation is changing, maybe the momentum is changing a bit. It gives you kind of an early alert that things are starting to happen underneath what is obvious underneath the general price chart. The same type of thing here, where you have the lower side where the market starts to move up, the predicted differences start to turn ahead of the actual predicted moving average and before the trend of the prices start to change. So the predicted differences are a good momentum type of an indicator and can be used, just like a number of your other types of indicators. I know quite often when you talk about what is going on with some of the other indicators, ones that you might be familiar with, you might be looking at some of the ones that are like stochastics. You look at MACD, and just to show you the comparison of those and how they look and what you're looking at when you're looking at there, we'll put those two on the screen, and just to kind of show you what that looks like in comparison what the predicted differences are moving. There you have in the middle area here, you have the MACD, and then in the bottom you have stochastic. I don't follow these as much as I do with the predicted differences, because I think the predicted differences tend to tell you some things, as you see right here where I'm lining them up with the that vertical line there, where you see where the turn started to come here as the market started to kind of run out of steam, the uptrend a little bit. MACD was still moving up. Stochastic had just barely started to turn down, so you had a signal in the predicted differences a little bit before you had the other indicators giving a signal. One of the things about stochastics, it can hang up above that upper threshold for a long period of time, as you see as it does here, and when it hangs above there, you go for a period of time without any real signal as to what to do next. So I guess that's one of the reasons that I prefer to look at the predicted differences as opposed to the indicators that you see down below. Now, there are some times here, of course, when you get the big candle, you see there, the big black candle, you see the MACD starting to move up from there, giving some early signals. Same thing with stochastics. It moves above that lower threshold, moves to the upside, indicating a long type of a position. But you'll also note here, as I mentioned earlier, we had the crossover and the predicted difference before that. And that was a little early. Of course, the market is still headed down there a little bit early, but you had the alert that something was changing a little bit, and you were starting to have a convergence of the predicted moving average and the actual moving average, indicating there was a little bit of difference, a change in what was going on with the underlying type of a strength type of situation. Now what we want to do is to cut back. We're going to take out these other averages, and we're going to talk about another vantage point indicator that I think is quite useful in terms of trying to determine where precisely to get price. what we have shown you with the indicators so far, when you look at those, is that we have a fairly good general sentiment of where prices are headed, but where specifically are we going to get on board? Where are we going to make our signals? What are we going to do? Exactly where are we going to place our stops, and where are we going to get on board? Where are we going to get out? First thing we're going to do, again, keeping in mind kind of the general shape of what this chart looks like over the last 6 months, we're going to cut the time frame down to just 3 months, and we'll be able to get a clear look exactly what we would do if we were trading this particular market. Now, in crude oil, a couple of things to mention also is that we are probably going to, it depends on the size of your account, whether you're trading the full size account or what. I'm kind of interested in limiting my risk. If I'm looking at the crude oil market, I'd like to limit my risk to $1,000 per trade. In the case, I might want to do 2 mini contracts as opposed to, one full-size contract, because it gives me a little bit more flexibility, plenty of loss to be able to use that to play the market without jeopardizing the overall position that I want to take. When we look at what we're going to talk about here, we're going to talk about some of the moves that we can anticipate by coming up with a, let's say I made one mistake here, and I need to go back to my computer screen and add on the indicator that I was going to talk about, and that is the predicted high and the predicted low. That is a vantage point, kind of a contract or a specialty indicator that Vantage Point offers, and that's a predicted next day high and a predicted next day low. We're going to add that to these indicators, and we're going to make a few extra lines on here, and hopefully we'll be able to, when we look at them, kind of read our way through them. The orange line that you see on the screen, that is a predicted next day high. That pink line that you see there is a predicted next day low. That range is valuable because it's, again, not a guaranteed type of a situation, but it suggests that here's a probability for where the range will be the next day, and it helps to provide some kind of more of a channel or more of a breakout type of an opportunity if you look at it and trade it in that manner. Now we're going to look at some specific examples, and then we're going to talk about where we're going to place our trades. The first one we're going to look at is when we get into a time frame where we started the downtrend, and we're looking at a period of time here where we're talking about the predicted low that we had here on May the 4th. I mentioned I like to limit my amount of loss to $1,000 per contract, and if I'm using a mini contract, that would be potentially I could trade 2 mini contracts if I'm going to risk $500 per trade. So what I'm going to do is say that if I have a move that drops $2 below the predicted low, I'm going to go short. $2 is going to kind of be my little leeway there for determining what type of a jab or a fake out or something that might occur that